Hello, welcome to Insignia Investments. My name is Rupratim Dotto, and today I'm going to discuss with you the top 5 lies about the stock market that you probably have heard and believed. Let's begin. At number 1, the biggest and probably the most destructive lie propagated in the market is that you can consistently beat the market. Whether you are an individual investor or an institutional level investor, this is an absolute lie. I did up some of the research work done on it and found that over the last 40 years, not one individual or institutional level investor has been able to constantly beat the market for 7 consecutive years. The reason is like this. Suppose you have a portfolio that is a market beating portfolio. Now, to ensure that you beat the market for the present scenario, you have to sell off your portfolio and register your profits. Now, once you do that, to stay invested in the market, you need to create another portfolio. This is exactly when you open yourself up to selection risk, which reduces your chances to be constantly able to beat the market by picking up the multi-bagger stocks. Now, remember, in a very good economic condition, specifically if you consider the year like 2017, around 3 to 5% of all the stocks in the market become multi-baggers. For all the other years, scenarios are not that good. So, do you really believe that one individual person can consistently pick up all the multi-bagger stocks for all the years? Realize the veracity of this statement, and I'm sure you'll be able to understand why you cannot consistently beat the market. The best thing you can do is be at the market, and when the market conditions are generous, beat it by 1 or 2 percentage points. The second most notorious lie in the market is that a zero risk trading strategy or portfolio can be built. Now, this is one of the promises that is usually provided by a lot of brokers and like fund investors kind of people. The truth is, it's really kind of false and misleading, this entire statement that they can build a zero risk portfolio or a zero risk trading strategy. Remember beta from the capital asset pricing model? That is not a proxy for volatility as most people claim. That is the proxy for the systematic risk. And remember, the crux of the CAPM is that the market will only compensate you for bearing risks that cannot be diversified away. So whenever you get a higher expected return, that means you are carrying some risk. And that is the exact reason why the market will give you the benefit by providing you with returns. Do you really believe that without carrying some amount of risk, people will be willing to pay you some money? It's not really true. In the present situation of the market and the capitalist structure, risk and reward go hand in hand. Just like you risk dying because you were born, you risk losing money in the market because you expect to make money out of the market. Risk is not a bad thing. What is bad is not being able to identify which can be diversified away and which cannot be. Remember, if a person tells you he can build you a zero risk portfolio, run away from that person. Just expose yourself to systematic risk, diversify away the non-systematic risk, and that's the best way you can ensure a constant earning from the stock market. At number 3 is another lie that is perpetrated by a lot of professional investors and a lot of professional investing asset management companies. They say that if you cannot be completely invested in the market, you need a professional investor for you to invest your money in the market. Now, though there is a huge business model working on this statement, I think it's a complete lie. Money can be made out of the stock market irrespective of whether you provide 6 hours of every single day on the trading floor or you're just doing your everyday regular job and letting your money work in the market. The reason for this is the money markets have been designed for your money to work, not for you to directly work, for your money to be invested and work on your behalf and earn money on money. The only thing that you need to figure out is 1, how much time you can invest, and 2, what is your risk appetite. Now, these are questions whose answers cannot be provided by anyone but you. So figure these answers out. Once you do have these answers, stick to this thing. If you cannot invest more than 4 hours a week in the investment market for doing research and realizing what your risk appetite and the other things are, the best thing I will ask you to do is go and invest in an index fund. The index fund is decently risky, has all the non-systematic risks diversified away. It is only exposed to the risk that the market in general is exposed to. That is, if there is a civil war going on in India, probably the markets will die. Other than that, it will always survive. And this kind of investments will always give you the return that the market is giving. So look forward to an investment portfolio where we have indices to invest in. If you have more than 4 hours a week, invest that time to research a few of the stocks that you think whose underlying business you understand. Once you do, you'll be able to screen out a few better ones from the worst ones. Once you can do that, you should definitely invest in the indices, but add to that a few more risk exposures in the form of certain other stocks, certain other companies which you believe fundamentally are strong investments. Now for that, I am sure you do not need a professional advisor. You can do it all by yourself, and there are lots of free materials nowadays available both on the web and a platform like YouTube to help you out with it. At number 4 is one of the lies that have cropped up in the recent years because of the growth of algorithmic trading. So a lot of investors claim that they have advanced strategies because of which they can earn higher returns. The truth is that most advanced strategies have historically performed as badly or as well as simple strategies. The truth is, most of the investing firms have access to models which are already used by a lot of other competitors in the market. Now, what this makes them vulnerable to is usually big hedge funds which are privy to a lot of advanced modeling take advantage of arbitrage, take advantage of market abnormalities. Now, spotting them is difficult. Most of the asset management companies do not have, in general, the expertise to spot out these arbitrage opportunities. They build up money by taking advantage of the market momentum. So instead of getting yourself into a convoluted market momentum strategy, it's equally good to just get involved in a simple market momentum strategy. I dug up a lot of research on the same and found that historically, simple strategies have performed as good, if not better, than complex strategies. Remember, complex strategies or advanced strategies does not mean that they are immune to markets or they do not have the inherent risks that are carried by the market. There are only a few strategies which actually undergo thorough statistical understanding and prove their earning potential is not the result of market momentum. Now, those strategies are a few out there. Some hedge funds actually have access to such kind of strategies, and usually by the time they become popular in the market, the arbitrage opportunity is gone, and hence that's why you see all these advanced hedge funds kind of evolving their strategies. No strategy can earn you money indefinitely. So if you're one investor who is just starting out with algorithmic trading, or you're just starting out with an Excel sheet based algorithmic trading, I'll suggest you not to get yourself into the mud of a lot of complex trading strategies. Keep it simple, earn well, use market momentum to your advantage. And at number 5, the biggest and probably the most corrosive lie in the stock market is that you cannot earn money from the stock market. This is an absolutely big lie, because if you had invested $1 in the US stock markets in 1802, that money would have compounded to around $18 million by the end of this decade. So by 2020, you would be a millionaire. The truth is, stock markets have not only outperformed commodities like gold, have not only beaten out inflation, but they have beaten out the fabled bonds and other government instruments and many other forms of investments like real estate, and have provided the most generous earnings to investors in the long run. Now, does that mean that you will not be able to experience a downturn? Maybe yes, you can, because all economies have this inherent risk of cyclic fluctuations. But in general, stock markets have been very generous. Even if you look through the years of 2009 to 2014, they have been very generous. Presently, 2017 for India was one of the best years for the investment market in India. And people usually lose money in the market and think that they did not make money in the market because of an inherent humongous expectation out of the market. People expect that they will invest 5,000 rupees in the market, and by the end of the month, they will be able to churn out 50,000 rupees. Remember, compounding is an instrument that helps you accumulate wealth. It's not a cheat sheet. It will not make you a millionaire overnight, until and unless you have done your extensive amount of research and know that you're betting against the market and you know the market is going to go foul in a few years. Remember, keep your expectations real. Keep your expectations around the 8 to 12% mark. I can guarantee you no other instrument out there will be able to provide you this good returns. It's a very stable form of the economy, and specifically for a country that is growing at a very fast rate like India is, stock markets will make you rich quicker than any other form of investment. So do not listen to anyone who tells you that you cannot make money out of the investment market. They're probably saying this because they were not able to, because they were not disciplined, dedicated, and not knowledgeable enough to make money out of the stock markets. And with that, we come to an end of this video. If you've liked it, give us a thumbs up. This was a general discussion as to the different lies that are propagated in the market. If you want to know anything more, or you want to tell us certain things about the market and share it with other people on the forum, do feel free to write about all those things in the comment section below. Let us know what you feel about this video also in the comment section below. Head over to our website www.insigniainvestment.wixsite.com/home. The link is provided in the description box below. For a holistic approach to investing, we write weekly blogs there and provide monthly newsletters. That has been all from our side as of today. Thank you and happy investing.